What if I told you that in 2008, a 119-year-old bank with over $300 billion in assets disappeared overnight? No warning, no dramatic shutdown, just a quiet decision made after hours. By sunrise, the largest bank failure in U.S. history was already complete. 12 million customers went to bed thinking everything was normal. By morning, their bank was gone. But here's the real question. Was Washington Mutual destroyed by the financial crisis, or did it help create the very storm that took it down? The answer isn't as simple as bad loans or bad timing. And by the end of this story, you may see the 2008 financial crisis and modern banking very differently. The collapse of Washington Mutual. On September 25, 2008, something extraordinary happened. One of the largest banks in American history collapsed. Not with sirens, not with headlines flashing across television screens, but quietly. That night, federal regulators seized Washington Mutual. By morning, it was gone. $307 billion in assets, more than 2,000 branches, 43,000 employees, 12 million customers. It remains the largest bank failure in United States history. But how does a 119-year-old institution disappear overnight? The answer begins more than a century earlier. Washington Mutual was founded in 1889 in Seattle, Washington. Just weeks earlier, the Great Seattle Fire had destroyed much of the city. Families lost homes, businesses were reduced to rubble. The community needed to rebuild. A group of local citizens created a savings bank to help working people recover. It was conservative, careful, focused on families. For decades, Washington Mutual grew steadily. It survived the Great Depression. It survived 2 world wars. It survived inflation, recessions, and financial panics. It built its reputation slowly. Trust was its greatest asset. But by 1990, the banking world was changing, and so was Washington Mutual. In 1990, Kerry Killinger became CEO. He had ambition, he had vision, and he wanted the bank to grow far beyond the Pacific Northwest. His goal was simple: transform Washington Mutual into a national powerhouse. Throughout the 1990s and early 2000s, the bank went on an aggressive acquisition spree. It bought smaller banks across California, Texas, Florida, and New York. Branches multiplied. Profits surged. The stock price climbed. Investors applauded the strategy. Washington Mutual was no longer just a savings bank. It was becoming one of the largest mortgage lenders in America. And that's where the real risk began. The early 2000s were defined by one thing: housing. Interest rates were low. Home prices were rising, and banks were eager to lend. Washington Mutual leaned heavily into mortgages, especially higher-risk loans, adjustable-rate mortgages, interest-only loans, no documentation loans, and option arms, loans that allowed borrowers to pay less than the interest owed, causing their debt to grow instead of shrink. These products generated high fees, and Washington Mutual wasn't planning to hold on to most of them. The model worked like this: issue the loan, collect the fees, bundle it into securities, sell it to investors. Repeat. As long as housing prices kept rising, the risks seemed manageable. Inside the bank, however, some employees began raising red flags. Loan files showed inflated income statements, questionable appraisals, borrowers who likely couldn't afford the homes they were buying. Risk managers warned that underwriting standards were deteriorating. Those warnings were largely ignored because the profits were enormous. Between 2003 and 2007, Washington Mutual issued hundreds of billions of dollars in mortgage loans. Growth became the priority. Caution became secondary. By 2006, housing prices stopped climbing. Then they began to fall. That changed everything. Borrowers with adjustable-rate mortgages saw payments increase sharply. Many couldn't afford the new monthly amounts. Homeowners who had planned to refinance suddenly couldn't. Defaults began to rise. As defaults increased, the value of mortgage-backed securities dropped. Investors became nervous. Wall Street started looking closely at institutions heavily exposed to risky loans. Washington Mutual was at the top of that list. Its stock began falling, from over $40 per share to $20 to $10 to $5. Credit rating agencies downgraded the bank's debt. Confidence weakened, and confidence is everything in banking. On the evening of September 25, 2008, federal regulators acted. The Office of Thrift Supervision seized Washington Mutual. The Federal Deposit Insurance Corporation stepped in as receiver. Within hours, a deal was arranged. J.P. Morgan Chase agreed to purchase the bank's deposits and most of its assets for $1.9 billion. By the next morning, branches opened under new ownership. Customers' insured deposits were protected. No retail depositor lost insured funds. But shareholders were wiped out. Bondholders suffered heavy losses. Thousands of employees eventually lost their jobs. And Kerry Killinger, who had led the bank during its rapid expansion, departed months earlier, with compensation earned during his tenure. No criminal charges were filed against senior executives. Washington Mutual's collapse was the largest bank failure in U.S. history. But it happened during a financial storm so massive that even this historic failure became just one chapter. The broader crisis led to millions of foreclosures. Unemployment climbed to 10%. The stock market lost roughly half its value at its lowest point. Entire communities were transformed. The U.S. Senate later released a detailed report examining the causes of the crisis, including Washington Mutual's lending practices. The findings were clear. High-risk mortgage lending, weak oversight, and a culture focused heavily on growth and profits had amplified the collapse. Washington Mutual had not caused the financial crisis alone, but it had played a significant role. The fall of Washington Mutual offers lasting lessons. First, rapid growth can hide deep risk. Second, incentives matter. When employees are rewarded for issuing more loans, regardless of quality, risk increases. Third, trust is fragile. Once depositors lose confidence, even the largest banks can fall quickly. Washington Mutual was founded to help families rebuild after disaster. Over a century later, it became part of one of the greatest financial disasters in modern history. Its story is a reminder that financial institutions are built on confidence, discipline, and accountability. When those foundations weaken, collapse can follow. Not with explosions, not with drama, but with a quiet decision made after hours, and by morning, everything is different.